But the first rate's pretty tempered, but the headline number is looking okay at 17,400. I don't think one can really complain at these levels. The market breadth, though, early days, but has started off with a smidge of a green. So you are seeing a tad bit of a better performance from the broader end of the market. The Nifty Bank then, with HDFC Bank, IndusInd Bank, all coming out with very robust Q4 updates. We're not really seeing a big reaction come in on the Nifty Bank, but yes, HDFC Bank is starting off with almost a 1% gain. IndusInd marginally higher as we speak. And then let's check in on AU Small Finance Bank as well, considering the disappointment it has been, wherein the loan growth rate has declined in the fourth quarter, but no, AU Small Finance as well, higher by about 1%. Intriguing market, this one. Bajaj Finance, is seeing a bigger reaction right now. That stock is holding up almost to 2.5% in the green. So big pop coming in on Bajaj Finance after them reporting the AUM growth best in about 4 quarters. Not just that, want to check in on what Reliance and ONGC are up to after the windfall tax withdrawal or reduction rather, coming into nil now. There's Vedanta as well, wherein the aluminum production is coming flat. The mine metal production is higher by about 2% on year-on-year basis. And Marico as well, which has shown a good recovery in the fourth quarter. The volume growth in India is now in mid-single digits, 0.6% higher for Marico as we speak right now. But for the index, Anisha, absolutely quiet. Any other stocks you're spotting?
Well, KPIT Tech definitely deserves mention. It's opened with a gap down of 8% after the 10-11% slide that we saw on Monday itself. So that note coming in with an underweight stance is something which is having a bit of an effect on that counter. So again, down 4% today. That stock definitely deserves mention. Then you have the Adani group of stocks which have opened up with a bit of a red tick. Talking about the windfall tax impact, not only ONGC, Reliance, but the likes of MRPL are also showing a positive reaction to that. So 4% higher there. FACT, which came out with its update as well, talking about the highest ever revenue, so 3% higher. M&M Financial is something that also deserves mention. PNB Housing, let's pull up that stock as well. Volume seeming to be on the higher side on that one, as well as Poonawalla FinCorp, wherein stellar disbursements of over 6,000 crore, not PNB but PNB Housing is the stock, as well as Poonawalla FinCorp, because the disbursements were rather strong there and the volume seemed to be picking up. So a lot of stocks are showing a bit of a momentum, and then the order wins coming in for the likes of NBCC, KEI, etc. are also quite excited. But the action, of course, is in the banking names as well as the NBFC space, and the market holding up steady. We are at 17,450 thereabouts, though there is a bit of an outperformance, if you must, from the broader markets, because the advanced decline ratio is looking quite positive as well.
Okay, let's find our first trades from our charters then. And Kunal, what is it that you're punching in this morning, given the fact that we have a breadth skewed in favor of the gaining side and we're holding out about the 17,400 mark?
So yeah, I think it still seems to be a good start for the indices. I know 40 points plus on the Nifty, some 100 odd points on the Bank Nifty. It's still an okay start for the indices. As I said earlier, that the action is more towards the stock specific. So the stock which I would be looking to suggest to clients would be on Bajaj Auto. My expectation is that the stock is heading towards a breakout about that 4,000 levels. Momentum is quite strong. Volumes are very strong for Bajaj Auto. So that's the stock which I look to buy.
What about you, Nooresh? What are the first trades that you are spotting?
So buying, adding on to Laurus Labs, a bounce back trade expected to go towards that 320, 330 mark in the short term.
Okay, let's welcome on board Mark Matthews as well. He's the head of investment research at Julius Baer as well. Mark, hi. Thank you so much for making time and speaking with us. Let's start with the market itself. After a long time of consolidation, the Indian market seemed to be breaking out a tad bit. Do you think the worst is over? And now valuation-wise, there's a lot of comfort available in the Indian markets.
I agree with everything you said. I think that we've had a nice period of consolidation to build a base, and the market is not expensive. And the earnings growth looks very robust in India on its own in absolute terms, but relative to the rest of the world, it looks very good. In the US, they will have at best flat or possibly slightly positive earnings growth this year, but it'll be low single digit. And in India, I think we can safely say it'll be in the mid to high teens.
Okay, so where do you see value at this point of time? Which is that space which would be, let's say, the top sector recommendation at this point of time, Mark?
Truth be told, I don't really go into the individual stocks in India that much, not because I don't want to, it's just that I don't have the time. But I'll cheat a little bit and say that what we like everywhere in the world is quality growth. So quality growth in the United States would mean something like a Apple or a Microsoft. And so you could extrapolate from that. In India, it would be something like Tata Consumer, for example, good quality banks, that kind of thing.
Sure, quite interesting. Also, Mark, just wondering as to what could be the implications on what is going on with the crude market. I mean, not just the sudden jump after, the decision from the OPEC, but also the fact that, for instance, we were just talking with Dr. Fardoon Fisheraki right now, and he was saying that he actually sees crude spiraling back to $100 per barrel levels by the year end. So just wondering as to, how is it that you hedge against higher crude prices, considering that's going to hugely impact markets like India?
Well, all I can say is I respectfully take the other side of the coin in that conversation. Our house view is that oil is going to trend back to the 70s. And the reason for that is there's lots of it around. And we view OPEC's decision as a sign of weakness, not strength. And the actual, delivery of 1 million barrels a day, in the past, they've had a hard time executing that. So it's a political move. And these days, politics ultimately are not, I should say, what determines the long-term price of oil. Maybe they did back in the 1970s, but there's so much oil around the world now, other sources, and natural gas, and increasingly alternative energy. And we do feel that long transition of the world's automobile fleet into electric vehicles is the big thing that is going to keep it from going up much. So as I said, we actually see it going back to the 70s.
Interesting. Mark, the other thing I also wanted to understand is we're almost on the cusp of earnings, and by next week onwards, we'll have, IT earnings come out here in India. Looking at the kind of price action and the news flow that we've seen from NASDAQ, do you believe that IT correction has sort of long overstayed its, due, and we are going to see a bit of a rebound? I mean, analysts largely are expecting that the margins are going to expand, perhaps marginally on a sequential basis. Is all the negative now in the price when it comes to Indian IT?
Well, I have to be honest that, once again, if I had the time, I'd love to be looking at it more closely. But perhaps I could answer your question once again more generically. And I think that analysts are going to be paying lots of attention to guidance in the coming earnings season, because in the fourth quarter, the tone from corporate sector was that the slowdown, if there was going to be one, is only temporary, and actually margins held up much better than expected in the fourth quarter. And so analysts didn't really make a lot of dramatic revisions, and so they'll be waiting very closely to see in the wake of this banking crisis whether the corporates are changing their tune or not. And I think it's too early to say, but allow me to also mention that the S&P, at least, has been an extremely concentrated and narrow market this year. If you exclude the 15 largest stocks, the S&P is actually flat on the year. And we think, as much as there could be a little bit of mean reversion in the smaller stocks, actually this rally in those quality growth stocks, the mega cap technology stocks, is probably going to continue, and they will probably continue to lead the market, and the market will probably continue to rise.
Mark, hi there, morning. Wanted to also get in your perspective as to what the expectation is from the Reserve Bank, because apart from tracking, of course, inflation domestically, the kind of central bank action as well that we've seen across the globe will be on top of mind. So what are you working with?
Clearly, the Reserve Bank is dealing with India's inflation and not the inflation in the rest of the world. So I'd start my response by simply saying that we don't think this rally in oil is sustainable. It was mostly short covering. We do not expect the oil price to continue to go up. India's inflation, as you know, is primarily driven by food most recently. And in fact, the inflation basket is in need of recalibration because it's measuring a consumer from the 1990s. And so anyway, we just have to live with that. But to the extent that food prices can moderate a little, I think that would take the pressure off. But for the Federal Reserve, there is a sort of conflict because on the one hand, their messaging is still that they intend to raise rates, but everything else is suggesting that rates are going to start going down as soon as September. That's what the futures market is pricing, and that's what various other markets and lead indicators seem to be suggesting too. On balance, I would think, particularly in light of the stress in the small banks, that the Fed will go on pause and follow the Bank of Canada and the Reserve Bank of Australia, and that would also help take some pressure off the Reserve Bank in India.
Should be a realistic return expectation from the Indian markets this year. We started off the year with very tempered expectations. Has it become better? Is it the same? Is it worse off? What are you penciling in for the annual growth, let's say, from Nifty?
High teens earnings, and I think that we could get high teens return in the stock market as well. I think that the dollar has peaked and it's going down, and that trend is obviously a very good one for emerging markets. The more the S&P just sort of chops sideways or maybe slightly up, the more people will look for alternatives overseas. Kind of like if you remember in the aftermath of the dot-com bubble collapse in the early 2000s, and the S&P was just sort of chopping around. That's when a lot of money started coming out to Asia. And I have friends who run a fund management company, and I'll just share with you some feedback they relayed to me when they were marketing in the United States last week. They said that investors in the United States were willing to dabble a little bit in China, but just a little bit. They didn't want to put in very much. And so I think that opens a lot of space for other large emerging markets like India to attract attention and money.
That was the comment coming in on China, wherein they're willing to dabble a tad bit into China. But what about India? Does it stack higher than China? Is it still lower and people have just started looking into India? Because as of now, the flows have turned slightly better, but for the year, we're still tracking very, very tepid flows from the FIIs.
Well, I don't want to ramble, but it's a very long answer because you have to realize the interest in China up until 2019 was very much concentrated in their internet apps like Tencent and Alibaba, Meituan, etc. And that story has been totally derated, but now it's kind of starting to look a little interesting again. I mean, those stocks are trading in the low teens price earnings wise, and you might have seen Alibaba has been cut into 6 pieces, which will probably allow those individual pieces to grow again at a faster rate than they could have in aggregate if they'd stayed as one conglomerate. Then on the other hand, India doesn't have those same big internet stocks, but it does have this very robust and young domestic consumer story. So they're just very different stories. But overriding all of it, I would say in conclusion, the geopolitics is not looking good for China, and that's the major restraint, I think, preventing foreign investors from putting a lot of money in there is the fact that relations between China and the U.S. are literally as bad as they've ever been. You've got to go back to the 1960s.
Fair enough. That's the view on India, China. But what about, really looking at the long-term story back home, in particular when it comes to the infrastructure pocket, given the kind of impetus that we've seen, policy initiatives, etc., by the government, a lot of market experts are betting big on the manufacturing theme in the country. Would you too remain positive here?
Yes, I do. And of course, infrastructure is a story which requires a stable government. And so that is the case in India. I don't see it changing with the elections coming up next year. And as long as you have continuity in government, then these long-term spending plans can be executed. And so, yes, I am a believer in that story. It's a good one.
Sure is. Mark, great to have you today on ET Now. Thank you for taking the time out. We just chatted with Dr. Feridun Fishraki, founder and chairman at FGE. He spoke with us exclusively saying that $100 on crude is not far away. Why does he say that? Let's listen in.
We see the demand growth this year, 2.5 million barrels per day, of which maybe 1.5 million barrels per day is COVID recovery, and 1 million barrels per day based on the strength of the market. So very bullish on the demand side. So if OPEC is seeing something, we don't see it at this stage. It is possible that they've had difficulty finding customers in Asia, particularly in China and India, as they're buying so much Russian crude. So they say, okay, we see some weakness in, maybe not in demand, but in procurement, and taking some action. I'm sure they have good reasons, but as of today, we can't see why they did it.
Dr. Fishraki, there is a saying in global energy markets, an old saying that oil business is 1% business and 99% politics. How are you witnessing geopolitical, tension between some of the large geographies which consume a lot and produce a lot as well? For example, US has now become net producer, net exporter of oil. How are those equations also playing a part in energy markets right now and these steps which are being taken?
Actually, I don't agree with the theory of 99% politics, 1% oil. I think that is 70, 80% of it is fundamentals, supply demand, and maybe 20% politics. So maybe that was true 20 years ago, but not today. US now is the largest producer of oil. And if you add crude and products together and condensate, the US is exporting more than Saudi Arabia. But US is also a huge consumer. And consumer means that most of the oil that they produce, they end up using it themselves. So they are different from Saudis, where they have extra oil that they export and they can control it. In the US, there are small producers, private producers. The government almost has no role in this matter at all. The government is just a bystander. So private companies run the show. But the geopolitics do impact things. At the moment, we see the Saudis and the Iranians reaching a diplomatic solution. We don't see any big geopolitical issues in front of us. In case of Russia, the price cap for Russia has failed. Russian oil still is flowing pretty much as before. And the Russians are basically replacing all of Europe with China and India and Turkey. And oil is still flowing at discounted prices, of course, but the flow of oil cannot be stopped by politics.
Time now to welcome on board Dr. Abhay Soy, the CMD at Max Healthcare as well. Abhay, hi, thank you so much for making time and speaking with ET Now. And let me start by congratulating you on being awarded the Entrepreneur of the Year by one of the leading publications. So let me start just with that. What would be that one advice that you would probably give to the entrepreneurs at this point of time?
Well, my only advice is keep working hard, keep at it. Times change. There's always ups and downs, but you have to be at it. And, you have to be relentless.
You have to be relentless, but what seems to be relentless at the moment is the surge in the COVID cases, right? We all thought we were out of the woods, but it seems to be increasing a tad bit. Is that concerning? What are you doing at Max to kind of gear up?
So right now, while we are seeing the number of cases have been increasing, and you've been seeing that in the press, the number of admissions haven't been. So it seems to be restricted to the upper respiratory. There's no cause of concern as far as admissions are concerned. We've hardly seen any admissions. We've only seen situations where in cases of comorbidities, we've seen certain admissions, etc. But that literally you can count over your fingers. We have more than adequate sort of capacity, and we've been through this so many times that the entire systems, the protocols, everything is in place. I think the entire machinery within the hospital system is in place to look at any surges that may be. But at present, I don't think there is any cause of concern really at our end, because like I said, we are not seeing any admissions really, so to speak of.
Good to hear that. Dr. Soy, what I also wanted to understand is whether it's a mild variant this time, and would you say weaker perhaps than Omicron? And if you could really identify, the symptoms, are they the same that were the case in, the previous variants of the virus as well, or much milder this time?
No, so I think it's a milder form of similar symptoms. We are seeing people recovering faster. Besides COVID, what is a cause of concern for us essentially is it seems to be that COVID has precipitated a lot of underlying issues in people. So we are seeing, whether it's diabetes, whether it's blood pressure, and so on and so forth. And these things have long-term implications. So right now, my concern is not so much on account of COVID and symptoms emanating from COVID, because I think they're fairly controllable, and we're not seeing any severe symptoms, so to say.
Okay, that's the word coming in on the spread or the rise in COVID infection cases as well. And as you said, a lot of problems being created on the back of that. But if we were to just get back to your business and talk about your margins, because they've been quite healthy in the range of about 26 to 27.7%. That's for the 9-month period. Given the fact that you're talking about new capacities coming up, what's your outlook on your margins? Do you think that you'll maintain this range?
No, absolutely. We are essentially elevating a business need. We have bottlenecks in terms of capacity at present. Our occupancies are close to 77, 78%. These are midnight occupancies. What that means is during the day, we have about 110 to 120% occupancy in most of our hospitals. We need to create more capacity. So what we are doing is we are creating adjacent capacity via brownfields. And when you do that, demand is much quicker on the ramp up, as well as the fact that you have operating leverage because your management cost and your clinician cost, etc., is already being incurred. So theoretically, your operating margins as well as EBITDA per bed should be significantly higher than your current capacity. Because it's a brownfield, these are not green fields. What we believe is you'll have expansion of margins rather than contraction.
Sure, but could you help us with a timeline with respect to when these capacities are likely to come on board? Because I was reading an analyst note which does suggest that the Shalimar Bagh capacity was expected to come on board already, but there seems to be a bit of delay. And similarly, with respect to Gurgaon, etc. as well, what's the timeline of operationalization?
So Shalimar Bagh capacity has come on stream as scheduled. It's already on stream. We were expecting it in the last quarter of the previous financial year. Now, and it came on stream, as scheduled. We are expecting additional 100 beds that we'll be able to sort of ilk out of the system, and we're expecting 300 more beds in Dwarka to come out by September. So within a space of 6 or 7 months, you're seeing about 500 beds on top of 3,400 beds. That's about 13% more capacity, and we're expecting about 1,000 plus beds next year. So I think in terms of capacity sort of rolling out, there's a large amount of capacity. And like I said, because it's brownfields adjacent to existing hospitals largely, it's quite de-risked.
Would you, for this particular planned capacity, would you have to raise additional funds, or are you well funded for the same?
So we are a net debt-free company. We have a net debt positive of about 500 odd crores. We have about 1,500 crores of close to 1,500 crores of cash sitting on our books, and we are generating close to about 250 crores of free cash flows per quarter, and it's expanding. The entire capex is at a cost of about 4,500 crores over the next 4 years. And this should be equal to close to about 50% of our free cash flows. So not only don't we require any debt or any form of external funding, but we have spare internal accruals as well post completion of this capex. So we find ourselves in quite a healthy place as far as this is concerned.
Expansion is going to be largely a brownfield, as you talked about, or inorganic opportunities is also something that you're watching out for?
So absolutely, inorganic opportunities is something that we have been watching out for some time. We've been engaging with a few players. And like I said, we have free cash flows to spare and unlevered balance sheet. And we're quite sort of comfortable levering it up to 2.5 times debt to EBITDA. That's a threshold we won't breach. So within that, we have elbow room to do about close to $500 million of acquisitions. So we've been searching out, we've been sort of combing out for and looking out for inorganic acquisitions as well.
Are there any more color in terms of what could be the timeline? At what stage are the discussions? Any particular geography or speciality you're looking at in terms of adding to your capacity through this inorganic route?
Yeah, so we like to stick to what we do, which is multi-speciality quaternary care. As far as geographies are concerned, we've have an identified list of 21 cities that we want to move into in the future. So these will be located in these cities. We have been in conversations for some time with quite a few players, and these things have their own sort of time frame of happening, and when they happen, they happen. I'm fairly hopeful that over the next couple of quarters, something should work out.
When you say 21 cities or 21 geographies, are they largely tier 2 or 3 cities, or are you specifically looking at metros and larger cities?
So it's metros as well as tier 2 cities, tier 1, tier 2 cities. We already have presence over there. We are in places like Mohali, in Uttarakhand, in Dehradun, in Bhatinda, and our experience has been quite good compared to even the metro cities of Delhi and Mumbai. So we're quite confident. These are also places where at least a handful of our competitors have proven viability. What we don't like to do is go into uncharted territories. So these are quite chartered, our peers have proven viability, and we're very comfortable about going there and doing it better, like we usually do in most of the geographies, or perhaps each and every micro market that we're present in. We're quite confident about that.
Right, good to hear that. You wouldn't be price agnostic, would you? Or is there something that you've particularly earmarked in terms of a size or scale of this inorganic opportunities that you're talking about?
So larger the better, but we are very conscious that we look for at least 20% ROCE on a cash-on-cash basis, over a space of 4 to 5 years. And so long as we have a clear line of sight towards that, those are the sort of opportunities we are looking at. We are less shaken by headline numbers, but like I said, it's more about 4 or 5 years down the line. That we must be able to underwrite a business case where we are looking at a ROC for about 20 to 25%. So yeah, that's really the threshold that we look at. And like I said, the larger the better the opportunities are.
Seems like you've already closed in on something to acquire.
Sorry, I didn't.
I know. I'm saying it already seems like you've closed in on some property already, or some acquisition target already.
Not really. I mean, if that was the case, then you would have read about it in the press, or at least we would have made an announcement via the stock exchange. No such situation right now. Like I said, we at any given point of time over the last few quarters, we've been engaged with at least a couple of parties, and more at times, and we are sort of quite conscious about deploying our capital to work. Our cadence is very, very well defined. So when we are looking at opportunities, we know the sort of geographies we are looking at. We know the kind of ROCs and the operational metrics, etc., that we visualize, that we view. Therefore, I'm able to quite explicitly state those. It doesn't necessarily have to do with any specific opportunities that we're closing out at present.
Got that. But great to speak with you. Thank you so much for taking the time out today.
Thank you so much. Wish you well.
All right, looking forward to a lot more details from the management of Max down the line as we get geared up for details on the inorganic expansion plans. All right, let's shift gears then. We've got Jayan Mehta. He's the managing director at Amul as well, now joining in on the show here to talk about their overall business outlook as well as volume growth and more. Thank you so much, Mr. Mehta, for joining in. So let's get a sense as to what kind of growth you're penciling in, because it's been 18% growth for FY23. What has really driven this? Has it been volume or value? And do you think that this 18% growth is here to stay?
Thanks so much. Good morning, everyone, for having me on the show. It's a pretty good time for the dairy industry in general and the cooperatives in particular. As you rightly mentioned, Amul GCF turnover this year grew by 18.5% at about 55,000 crores. And the Amul brand turnover is about 72,000 crores, making it the largest FMCG brand in the country. This has been driven by both value and volume. And we are been consistently growing at about 15-18% over the last decade. So this is for sure, this volume is going to continue for a long period of time. The good part has been the return in demand post-COVID, and that's been aiding the growth in all the consumer products that we work with. And more importantly, the kind of outlook that we have for adding more products in our portfolio, working on developing the organic products business, and a lot of other opportunities in expanding the cooperative network across the country. All this will help in maintaining, in fact, expediting the growth rate in the times to come.
Right. You've recently taken charge as well as the new MD after Mr. R.S. Sodhi. Just wanted to understand, what direction do you wish to steer Amul in for, say, the next decade?
See, Amul is a 76-year-old brand. GCF, our organization, is completing 50 years this year, and I have been here for the last 32 years. So practically, this is an engine powered by 36 lakh farmers, and the kind of volume and the distribution network that we have. I mean, the only direction we can move forward is one, and that's upward. Having said that, as I mentioned, there have been positive times for the cooperative sector. The kind of support the government is giving to cooperatives across the country by recognizing that cooperative is now a tool of development for upliftment of the people in the marginal section of the society. So, I mean, on one side, the government has already announced that they want to set up 200,000 more village cooperative societies, dairy cooperative societies across India, in addition to the 2 lakh current societies that we currently have. So what happened in the last 50 years is going to happen in the next 5 years, which means more milk will flow into the organized sector, and that will bring in more business opportunities for all the brands associated with cooperatives across the country. More importantly, we are promoting 2 new multi-state cooperatives, one for exports and other for organics, which means all cooperatives in the country will get an international market access for their products. Amul, of course, is exporting to more than 50 countries, but here we are looking at large number of cooperatives across the country finding international market for their products. Right. And the second is the organic initiative, where we'll connect with organic producers, and we have a brand for promoting organic products. So these are the 2 great business opportunities that we are working with in addition to developing our dairy business.
Okay, so a lot of opportunities lined up for Amul, but Mr. Mehta, I wanted to get your take regarding the prices, because the retail milk prices have soared, 15% in the last 1 year, the highest that we have seen in a decade. Where do you see the prices trending from here on? Because there have been a slew of price hikes taken by yourself as well.
I think the point you made is right, but you don't look at just 1 year, you look at 4-year period, because from 19 onwards, we had 2 years of COVID in which there was no price increase taken by anyone. And then we had to take care of the increased inflation for our producers, increased cost of feed fodder, and the other issues related to milk production. So the last 1 year was a bit abnormal, but if you look at it in 3 to 4 years perspective, the price increase for milk for the consumers has been more or less in line with the inflation. Having said that, the producers also have to be compensated for the increased cost, and that's why we had to take very, very calibrated measures in increasing the price of dairy products. But I think now the situation is pretty good across the country, and when the flush season in north ends, the flush season in south starts. So we will see increased supplies of milk coming from the southern part of the country, and obviously the next flush season for the north and west is also going to be superb. So things should be pretty good for the industry in general. And I don't think there is much reason to worry on that point of view.
So Are you saying the bulk of the price hikes are taken and now at least the prices have stabilized, or there could be still some upside?
I mean, I can only talk about Amul, and that's what the perspective I raised, that now milk procurement has, I mean, we did see a dip in the milk procurement last year because of the issues which I just mentioned. But now we are past that. There's been a growth in milk procurement in our system in the month of March, which was about 3%. From April onwards, we are looking at 6 to 8, 10% increase in procurement in the times to come. So at least for Gujarat, things are pretty good, and that's where we are currently.
Okay, you also had a plan to achieve the sales turnover of 1 lakh crore by 2025. Do you think large part of the upside will now come from the value-added products as well, or is it going to be milk and dairy which will continue to have the largest share in terms of growth as well?
Yeah, we have a portfolio which is a quite balanced portfolio. Fresh products, which is actually the best form of value addition, which means you sell milk, buttermilk, curd, paneer, fresh every day morning with a very high turnover. I think it's half of our portfolio. Value-added dairy products like the butter, cheese, ghee, shikand, all growing at more than 20%. Are another strong part of the portfolio. Our commodity business through our dairy trade portal, we are getting the best prices. And fourth is the international business. So that way, these are the 4 core business of Amul, which have been doing very well. In addition to that, I mentioned about our focus on organic space, and that's also going to give us additional business because now we are in space of almost every item that you consume in your kitchen. So be it organic atta or organic rice or different types of pulses, we are soon getting into sugar, jaggery, spices, and so on. So a big portfolio of organic products supplementing the already strong core dairy product portfolio makes Amul a very, very strong and a formidable brand, both in the mind space of the consumers and as far as the distribution muscle is concerned, and more importantly, the connect with the producers.
Mr. Mehta, you are very close to the rural side of the economy as well. Could you talk to us about how that is doing with respect to how the income has gone up for the rural India at this point of time, how the demand momentum is also there?
Yes, ma'am. The point is here very simple, that whatever consumer spends, I mean, if you spend 100 rupees on Amul products or dairy products, 80-85% share goes to the farmers. So the higher the growth in the business means more income for the producers. And once the producer takes care of the cost of feeding the cows and other things, the disposable income there also boosts the rural economy of the country. And milk, as we have seen, there has been no major decline or dip in the prices, and we can look at 10, 20, 30, 40 years period. So despite good increase in production of milk consistently across decades, we have seen the prices also remaining at stable level thanks to the intervention by the cooperatives in the system. So the farmers definitely benefit out of working with dairy cooperatives, and Amul is a shining example of that.
Not just dairy cooperatives, but other than that, what is your own sense on how the rural economy is shaping up right now? Because, you know, up until last year, we saw that urban India did way better. So just wanted to get a sense at large from you.
I mean, I can. We work with almost every single village in Gujarat and about 18,600 villages of Gujarat and more than 10,000 outside Gujarat also. So our sense is that there is optimism in the rural area thanks to the buoyancy in the market and the expansion plans that we have, which means that more milk they produce will be absorbed in the system. The effect of productivity enhancement and productivity improvement also is helping the farmers, which means their interest in the cattle breeding continues to be there. And once this buoyancy is there, they would invest more into the cattle and their incomes increase, which will mean the growth in the rural economy also. I mean, agriculture, dairy contributes to 1/4 of the agriculture or more than that. And the buoyancy in the dairy sector definitely contributes to growth in the rural economy of the country.
Okay, Mr. Mehta, we'll let you go on that note. Thank you so much for joining us and talking to us about a whole host of issues. For now, the market is actually holding up quite strongly. So 17,480 is where we are at the highest point of the trading session. So we are building on to those gains. Though a bit of an underperformance coming in from the mid-cap space, which is seeing a cut of 0.25%. The Sensex is up 0.6%. Small cap index is also holding up, but the mid-cap is the space where there's a bit of a pressure. Sectorally speaking, it's the NBFCs that are doing quite well. So Bajaj Finance, for instance, is up around 4%. Bajaj Finserv, the holding company, is also sitting with a gain of 2.5%. Then you have HDFC Bank, good up a good 2.5%. HDFC is holding up with a gain of 2%. So a lot of these names are actually doing well. What's not doing well today is autos. That's definitely on the back foot. So Bajaj Auto, we just got the numbers wherein exports continue to show a bit of a decline. So Bajaj Auto continues to be on the back foot, and some of the PSU banking names are also seeing a bit of a profit booking. So Punjab Sind Bank, Maharashtra Bank, UCO Bank, they're all sitting with cuts of around 2 to 3%. Individually speaking, in terms of the other stocks, let's pull up a Nykaa as well that suddenly spiked 5%. Not sure if there is any update coming in from Nykaa, but that's holding up pretty strongly. Last week, there was a bit of decline given the leadership churn that we had seen at Nykaa. So things stabilizing as far as that is concerned. NBCC reacting to the order inflow news. And then Varun Beverages also holding up in the green. Sonata Software, Federal Bank, Adani Transmission and Bharat Dynamics. These are the stocks which are in a bit of a red. So updates for Bharat Dynamics and Federal Bank have been lower than what's really expected. And that's the reason those two stocks are in the red. But time now to slip into a very short break. Don't go anywhere. Lots lined up when we come back.
Back with first trades right here, Neeti. Now, the first trades have stabilized somewhat. Not that it's a very big move of a day, but the Nifty holding up almost about 0.5%, and we're well above that 17,450 print is definitely not bad. In pole position, of course, Bajaj Finance and Bajaj Finserv after Bajaj Finance's Q4 numbers. Similar is the case with HDFC Bank. After HDFC Bank's Q4 update, L&T, ITC, ONGC, TCS are some of the other names which are holding out in the green. On the flip side, though, there's Eicher Motors as well as Innocent Bank, which is actually lower. So is the case with an ICICI Bank, with an SBI, and M&M along with Axis. These are the ones which are the drags in today's trade. The breadth of the market is not looking all that gung-ho. Bharat Forge, after the Class 8 truck orders, dipping quite significantly, both month-on-month as well as year-on-year. SAIL, BHEL, Hindustan Copper, and then Federal Bank is the one which is sharply lower today. That's down 3.6% as we speak. But Hindustan Zinc may not go ahead with its proposal to buy Vedanta's international zinc arm assets, according to an Economic Times report. Remember, the government had objected this acquisition, and since then, Hindustan Zinc has not presented any non-cash deal option to the government. We have with us Baninkar Patnaik from the Economic Times joining in on the show right now to talk about this particular story. Baninkar, tell us what is exactly are you picking up from your sources? What is in the works for Hindustan Zinc?
Well, my sources tell me that the company, which is Hindustan Zinc Limited, whose board had approved a proposal to buy out parent Vedanta's global zinc business in a 2.98 billion cash deal. The board had approved this proposal on 19th of January. So my sources are telling me now that they may not pursue this proposal because of government opposition. Remember, government is the biggest minority shareholder in the Hindustan Zinc. It has got 29.54% stake in Hindustan Zinc. So without this government support, this deal cannot go through, because according to SEBI regulations, any related party deal will require the approval of the minority shareholder by a majority. So it so happened that after the Hindustan Zinc board approved this cash deal, the government nominees on the board opposed the deal, and subsequently the share prices of Hindustan Zinc also dropped. And it forced the government to defer its, plan to sell a part of its stake in Hindustan Zinc to the next fiscal. Earlier, they were planning to do it this fiscal through the OSS route. So, because of this uncertainty, the government was forced to defer the plan. So now, my sources tell me that Hindustan Zinc is unlikely to act on the proposal to buy parent Vedanta's global zinc business. And in any case, if they don't, get this proposal ratified by shareholders within 3 months, then it will automatically lapse. So there is a chance that Hindustan Zinc won't, will let it lapse.
Shelving the plans for now for Vedanta's zinc business. That's Hindustan Zinc in the spotlight. Thanks so much for joining in. Let's move right on then. And we've got with us Patanjali Keswani, Chairman Managing Director at Lemon Tree Hotels, to talk about soaring prices, the outlook on demands, the government's tourism push impact, and lots more. Thank you so much for taking time out. And, we've clearly been paying phenomenal prices of late. A lot of hotels have been booked out. We've been paying double across the board, and it seems that now hotel prices are looking to keep rising over the next few years, given the state of the hotel industry and things having opened up, of course, post the pandemic. What is the outlook on ARRs and rates in general, Mr. Keswani?
So, well, if you look back at the rates, say 15 years ago, our rates today, and I'm talking about the hotel industry, are still 20-30% below those. So this is just to provide context. I think, what are you comparing the rates to? So when I look at India, you have to keep in mind that the factor costs, the input costs are very high, whether it is interest, length of debt, whether it's the cost of land. So from that perspective, the rates today are actually very reasonable, in my opinion. And if I compare it, as I said, to 15 years back, they are 30% below that. So and why did this happen? Why did the rates come down? Is because in the last 15 years, for most of that period, there has been a greater growth in supply than in demand. Now, going forward, and you have to keep in mind that the hotel industry is like the oil industry. A very small imbalance in demand and supply leads to a huge difference in price. You must have noticed that just a few days ago, they talked about cutting global supply of oil by 1%, and they're expecting the price to go up by 10%. So the hotel industry is rather similar. So here is the deal right now. My opinion is that for the next 4 to 5 years, demand will continue growing at about 1.5 times the GDP, which is about 8 to 10%, and supply is going to grow at 5. So sorry to disappoint you, but I think every year for the next 4 years, prices will go up by anywhere from 20 to 25%, as it happened way back in 2004 to 2008. And occupancies will also increase. So bottom line is that you are going to keep seeing higher prices till such time the return on the assets, the ownership of hotel assets, it's about 17-18%. So that's the bad news.
Yep, but you're, I'm sure, smiling on the back of that news. We, of course, as consumers aren't. But there's been the recent news as well, a 22 lakh, what you've acquired, 22 lakh CCPS of Fleur Hotels. Can you tell us a little bit more about that expansion, what the rationale is?
Well, Fleur is an asset company which we co-own with the world's third largest pension fund manager, the Dutch pension fund called APG. We own roughly 60%, they own roughly 40%. So during COVID, they had, bought preference shares worth 175 crores or invested in Fleur, preference shares worth 175. So our thinking is very simple. We had two options. We had to either put in an equivalent amount of money to maintain the shareholding because these are quasi-equity, or we simply buy out 60% of this investment they made so that we equalize our shareholding. And that's what we are doing. We're just buying their CCPS to stick to the original shareholding.
Hi, good morning. This is Anisha also joining into the conversation. What's your plan with respect to capacity addition and room addition going forward? Because you recently signed a licensing agreement in Bangalore as well. Plus, there have been a lot of updates with respect to different cities where you're looking to enter. Could you talk to us about what will be, let's say, the number of rooms by the end of FY24?
It will be about, I would reckon, about 10,500 rooms. So we will have roughly 6% of Indian supply. That is what we will control. Part of it, well, a majority of this new supply addition will be asset light, which means it will be hotels we manage on behalf of other owners. And of course, we are setting up our own hotel, which is India's largest hotel in Bombay, which we will open in Q3 this year, which is a 670-room hotel near the international airport. So we will add about 2,000 rooms in this year. By the way, I noticed you're talking about supply. I just want to put it in perspective. All the consulting firms that cover hotel supply are kind of agreed that the rate of growth of supply for the next 4 to 5 years will be about 5%. Unlike the previous 15 years when it was about 10%. So supply growth going forward will be about half to 2/3 of demand growth, which normally is about 10%. And therefore, there will be a supply-demand imbalance in favor of demand in the next 5 years.
Okay, fair enough. Looking forward to that new hotel as well. Now, what about corporate travel demand? Has that now reached those pre-COVID levels? How is it stacking up compared to leisure demand, especially in light of the fact that we've seen an increase in inbound travel? We've got the G20 presidency. You had the wedding season as well that looked pretty optimistic.
So there is an increase in all segments. But corporate, if I look at it on an absolute basis, yes, it is perhaps back to pre-COVID levels. But I expect it to do much better than that, actually, because the GDP has grown fairly significantly from pre-COVID levels. And that implied improvement in demand, while it has not been directly proportionate because there has been some reduction due to work from home and so on. It will catch up. So I think I've said this publicly earlier too, that I expect that October onwards, corporate demand on a share of total demand basis will catch up to pre-COVID. Retail demand is phenomenal. It is both leisure and business. I find a very interesting phenomenon now that about 50% of our customers are 10 to 12 years younger than the other 50. And these are really people in the gig economy, they are under 30, they are aspirational. So I find this the most exciting part of the change in our customer segment, which is a whole bunch of young people who are now staying with us, who, as I said, are aspirational and ready to spend money in branded hotels. As far as weddings go, yes, there is a big pickup in it, but it has always been so in India. I think the big news will be when foreign travel starts on an equal to pre-COVID basis, in which case demand will shoot through the roof. And I expect that to happen from Q3 this year.
Right. I also wanted to understand, as per your 5-year strategy, you plan to achieve and maintain this 50% EBITDA margin over the next 5 years. And maintain the 10% reduction as well in the overhead costs. How is it that you plan to achieve these numbers?
See, it's quite simple, actually. What happened during COVID is the whole hotel industry was forced to re-examine their cost structure. And what happened was that, over time for any large company, which has, thousands of rooms, flab builds in the system. So I think this is true for every hotel chain in India. During COVID, they re-examined costs and to a greater or lesser extent, found a lot of flab which they eliminated. Now, the point is good times are coming ahead. I expect as good or prudent risk management, every hotel company will try and ensure that those flabby costs don't come back into the system. So our EBITDA margin, yes, it's crossed 50%. I have also said in many fora that, we will ensure that we maintain it. But even the other chains, if you look at them, they've gone up, they've saved improved their EBITDA margins by 3 to 5%. And I think that's commendable for the whole industry. And I hope that continues, that focus on costs. Number two, if revenues increase, then automatically in this business, since a large element, more than half your costs are fixed, when revenue increases, automatically your EBITDA margins improve. And I expect this, again, as I said, to play out across the entire industry.
Property of near the Mumbai International Airport that you talked about, when is it coming on board and what kind of accretion will it do in terms of revenue as well as EBITDA?
So I expect it will soft open by October this year. We are investing about 1,000 crores and it's a debt-free investment. It is purely from internal accruals. We have already invested, I think, about 600 crores. This will generate on a stabilized basis, I think about 320 crores of revenue and about 190 crores of EBITDA
All of the funding
from the following year.
I know you talked about that this one is at least funded through internal accruals, but overall at the balance sheet level, are you expecting the debt to go up because of the rapid expansion?
No. In fact, we are quite significantly cash flow positive because, we have, even when we are hypothetically, we were PBT or PAT zero due to depreciation, we have cash of about 100 and some crores. So, my expectation is that Lemon Tree as a standalone entity will be debt-free in the next 3 years. And Fleur Hotels, which is the joint venture where a lot of capital expenditure has occurred just before COVID and now, will be debt-free by an additional year or two. So as a group, we should be debt-free by about 4 to 5 years from now.
Free at the group level in the next 4 to 5 years. Mr. Keswani, appreciate you joining us and talking to us about how the balance sheet looks like, what's the expansion plan, and more importantly, how the room rates are likely to inch only higher. But on that note, let's welcome on board our technical experts back to talk about what are the charts and the stocks that they are spotting for us. Nooresh, you go first. What's the chart buster idea? Unmute yourself.
Yeah, that's a chart for Ahluwalia contracts. I've earlier covered, if we look at it, NCC and other infrastructure names, and now it is Ahluwalia, which is another one in the basket, which has given a clean breakout. The stock had a lot of resistance around 530 to 545 levels. That was the top for the last year and a half. Finally, it has broken out a classical cup and handle formation and a breakout. Good volumes in this move from 500 to 560 odd levels. And say after the breakout, we could expect some bit of a pause here, and that's the time to accumulate the stock between 570 to 530. Technical target price for the stock would be 700 to 750. A stop loss to be kept at 510.
Right. And Kunal, what about your chart buster?
So, Aisha, it's on Bata India now. It's in a bit of an interesting chart because the stock has been correcting very sharply in the last 6 to 8 months. In fact, Bata India is currently at a major multi-month, multi-week low for itself. Interestingly, the indicators have started to show signs of a turnaround. So as you can see in the charts that the stochastic indicator is on the verge of giving a bullish crossover. And the last 3 historical incidents for Bata India have resulted into very steep kind of rallies for the stock price. So would be bullish on Bata India, and if the crossover gets confirmed on the daily charts for the stock price, I would expect the stock to rise up to at least 25 to 30% in a span of the next 12 to 18 months.
Okay, let's get in some stock-specific ideas and trading recommendations as well. Nooresh, on your list?
So maintaining the buy on Laurus Labs for a bounce back trade. A stop loss at 297 and a target price of 330. Second is a buy on Indian Hotels, a preemptive buy here, a stop loss at 310 and a target price of 360.
Right. And Kunal, what about your stock strategies?
So even I have Indian Hotels. That's a buy from my side. Targets of 338, stop loss at 313. And the second would be a buy on L&T. You can't miss out on this large cap name. It's coming back into its groove. Expecting a breakout pretty soon for L&T as well. Targets of 22.75, stop loss at 22.25.
All right, those are your top strategies. Both of our experts betting on Indian Hotels or IHCL. Time for a very short break right here on the show. Stay with us. We've got lots more lined up. Welcome back. Still tuned into First Trades. A quick check-in as to what things are, what's really moving around in the markets. And for now, it continues to be flattish on an index level, ditto when it comes to the broader markets in terms of identifying some movers on the Nifty 500 then. And you've got names like SCI, Federal Bank, Adani Transmission, along with Cummins, BHEL, Bharat Dynamics as well. They're under a bit of pressure. On the flip side, though, you've got a Vaibhav Global that's spiked up. NBCC is looking smart. Something like a Cyient along with IGL. Those are the movers on the upside. But all eyes on the MPC meet outcome. We've got Upasana Chachra, who is the Chief India Economist at Morgan Stanley, now joining in to give us a take as to what to expect. Thanks so much for taking time out, and it seems like it's unanimous in terms of the expectation with a 25 basis points rate hike this time around. Is that what you're expecting as well?
Yes, so we are also expecting a 25 basis points rate hike tomorrow. We think that should be the last rate hike in this cycle. So we're looking at a terminal repo rate at 6.75%. I think the upside in the inflation numbers that we got in Jan and Feb sort of cemented the case for another rate hike, but this should be, marking the end of the rate hike cycle in our view.
Right. Upasana, it seems like a 25 bips hike could well be in the price because this is an assumption that, the market has been talking about for a while now. But wanted to understand what from within the commentary would you be looking out for? And could that really be the cue in terms of the future trajectory of the rate hikes?
Yes, that's right. I think markets are expecting a 25 basis points rate hike. Consensus is expecting the same. So yes, to that extent, it's all positioned towards a final sort of a 25 basis points rate hike. The key to, I think, watch out for in tomorrow's meeting would be on the stance. So we are not expecting a change in stance. We think that the external factors, the uncertainty around them has increased especially in the last month. So we think that RBI or the MPC will likely not change the stance tomorrow. But I think that's one key thing to watch out for in terms of how, or if any, there's any change in the wordings of the stance from the RBI. And secondly, I think liquidity is also on top of everyone's mind. So anything on that front that RBI indicates, again, we are not expecting too much coming out on the liquidity front as well tomorrow, given that we think that RBI will do a rate hike and also not change stance. So in that context, it will be sort of inconsistent to come up with any other measures in view of the liquidity issues that are on top of people's mind. But I think those two would be important. Apart from that, any changes to growth and inflation numbers, I think there could be some mark-to-market adjustments to the inflation numbers given the, taking into account the updated data that we've got for Jan and Feb. But we're not expecting any meaningful revisions for fiscal 24 from the RBI's estimates. And similarly for growth as well. So RBI is expecting GDP growth at 6.4%, but that's for fiscal 24, and we've just started the year. So I don't think that we at least we are not expecting any major changes on that front as well from the RBI, at least in tomorrow's meeting.
Is going to really be on top of mind in terms of what the decision will largely be led by? Do you think inflation continues to remain the niggling worry? Is it also going to be the kind of rate hike moves that we've seen from central banks across the globe?
So see, RBI's mandate is to bring inflation below the 6% mark and to keep it in the 2 to 6% range. And to that extent, we've, sort of had inflation tracking above the 6% mark, apart from the November and December readings that were somewhat below that. So I think, yes, inflation remains center stage for RBI as well to ensure that, RBI's actions or the MPC's actions are in sync with their mandate to bring inflation down. So the key factor for RBI, as it has been until now, will be inflation. And we saw that upside surprise on inflation. Core inflation too remains sticky. So I think that is going to be the key driving factor for another rate hike tomorrow. But beyond that, I think RBI should get some comfort on the inflation trajectory. We think that inflation would be closer to 5.5% in fiscal 24. RBI's current estimates is also lower at about 5.3%. So I think beyond, this upside that we saw in the last quarter, inflation numbers will steadily or gradually go down and remain below the 6% mark. That should give comfort to the RBI.
Okay, fair enough. And what do you believe is going to be the outlook going down the line? While this time around the expectation is that there is going to be that hike to about 6.75%, what are the future rate trajectory actions that you're penciling in from the RBI? Upasana, I think you need to unmute yourself. Yeah, go ahead.
Yeah. As I mentioned, this should be the last rate hike from the RBI in this cycle. But beyond this, we expect in our base case rates to be on hold until December of this year. We have a shallow rate cut cycle in the starting from first quarter of next year. So we build in 50 basis points of rate cuts. So 1Q 24 and then 2Q 24 calendar year is where we pencil in 25 basis points each of rate cuts, primarily driven by an improving inflation outlook. So going into say fiscal 25 or calendar year 24, we see inflation more closer to the 5% mark or a tad below 5% if we take into account fiscal 25. And we think that will allow the RBI to start a gradual and a shallow rate cut cycle. And in our framework, we are working with the real rates of around plus 100 basis points or thereabouts. And we think, as inflation moderates and that visibility becomes more entrenched for the RBI, the RBI can look at a rate cut cycle, but we have that starting from the first quarter of next year only.
Upasana, great to have you on the show. Thank you so much for taking the time out and speaking with us today. Let's see what the policy has to throw up tomorrow. Before we move on, let's also take stock of what the commodity markets are up to, while equities, of course, are having a good day today. Ashesha is here with a quick update. Ashesha?
Well, yes, the most important point or talking point in the world of commodities is the rise in precious metals that we have seen in the last 24 hours. First, we'll talk about gold prices. Gold prices have risen above that $2,000 per ounce mark yesterday. Weak US economic data is the primary reason why gold prices have risen. In fact, in domestic market as well, gold prices have risen. On MCX, gold futures have recorded a new high of 61,400 rupees for 10 grams. Silver prices, meanwhile, have also seen an uptick. In fact, silver prices on MCX have risen above that 75,000 rupees per kg mark. Let's move on to crude oil prices then. Crude oil prices continue to rise after OPEC Plus announced output cut on Monday. So Brent crude prices have now risen to that $85.3 per barrel mark. In fact, Brent crude prices have risen nearly 11% in the last 1 week alone. Let's also talk about industrial metals then. Weak US economic data continue to weigh on industrial metal space. Aluminium prices have declined 1.3% yesterday, and they are down nearly 2.5% in the last 2 trading sessions. Meanwhile, copper prices also continue to decline. Zinc has recorded 4th consecutive day of decline. It is down nearly 5% in the last 4 trading sessions. Meanwhile, let's also talk about sugar prices then. Sugar prices have risen both in the domestic market as well as in the international market. Domestic sugar prices have now risen from 32,250 rupee per ton mark to 33,500 per ton mark. Supply concerns from Karnataka and Maharashtra is the primary reason why domestic sugar prices have surged. Meanwhile, global sugar prices have also seen an increase. In fact, global sugar prices are at the highest levels that we have seen since October 2016. And supply constraints from the top 2 sugar producers of the world, India and Brazil, is the primary reason why global sugar prices are rising.
All right. Thanks very much, Ashesha, for giving us those details.